Hi, everyone. This is Jelena Ogilvie, Partner and Director of Business Development here at Principal Wealth Partners. And I am excited to introduce Matthew Sommer, who is head of Janus Henderson Investors Defined Contribution and Wealth Advisor Services team. This is a team that provides client insights regarding a number of topics, including regulatory trends, legislative trends, and financial and retirement planning strategies. His 28-year career was also spent at Morgan Stanley Wealth Management and its predecessor Citi Global and Smith Barney, during which time his roles included both Director of Financial Planning and Director of Retirement Planning. Matt also received his bachelor's degree in finance from the University of Rhode Island and an MBA with concentration in finance from Pace University, Lubin School of Business. He also received a doctorate degree in which his doctoral candidacy research was selected for publication in both the Journal of Financial Planning and the Journal of Personal Finance. That is so impressive. He's also a frequent guest on CNBC, Bloomberg Television, and extensively quoted in various industry publications, including The Journal, Barron's, and Investment News. The conversation today is tax-savvy strategies, and we will discuss two things. One, where we stand from a legislative standpoint, and number two, the 7 strategies to consider, regardless of legislation, to create more efficiency in our investment portfolios. For all of you listening that are clients of Principal Wealth Partners, these are all strategies that we utilize and consider for our clients. So I'm excited to share these with you, and I hope you enjoy. Well, welcome, Matt. We're so thrilled to have you today. And I have to tell you, I don't know if you know this, but if you go on LinkedIn and you search your name, there's another option out there. There's another Matthew Sommer. I don't know if you know this. It's not Head of Defined Contribution and Wealth Advisor Services, which is your title at Janus. His title is actually Ski Then Beer. So as interesting as that man sounds, I'm glad we don't have him today, but rather we have you to talk about these tax savvy strategies. And although we didn't get this tax reform that most of us anticipated, I think a lot of us still like to complain about paying taxes and are always looking for ways to mitigate, manage it more efficiently. So the idea today is to hear some ideas from you and from Janus, what you're thinking that we can be considering in our portfolios and our investment strategies. But if you could also even start with where you think we are today, because every day it's changing.
It is indeed. So hello, everyone, and thank you very much for having me today. I'm going to go ahead and pull up some slides, which I think will be helpful as we go through some of these topics, which can be somewhat confusing. But what we thought we would do today, as you suggested, is really 2 key items. First, where are we today? And then secondly, what are the things to think about as we approach December and year end? So this could have been a very different discussion had we had it about a month ago, because the expectation was that ordinary income tax rates, long-term capital gain rates, and how the estate tax works would have become much more prohibitive. The good news is where we stand as of today, and you'll notice that I have November 7th on my slide, but even today, which is a little bit later in November, all of these proposals are now off the table for a variety of reasons. And our best guess is that the tax regime in 2022 is going to look a whole lot like it does in 2021. That said, there are some proposals, I call them around the edges. There's a proposal for households with more than $10 million of income to pay an additional 5% surtax. There's also proposals that would limit ongoing contributions for people who already have $10 million or more in their retirement accounts. Perhaps of most interest, particularly for those of you who reside in the Northeast, there's ongoing discussions to bring back more flexibility in terms of taking deductions for state and local taxes, which, as we know, for the last couple of years have been capped at $10,000 per year. So at this point, we're going to keep a close eye on things. We're going to see how events unfold as we get into Thanksgiving and shortly thereafter. And while anything could certainly come up at the last minute, it seems as if all indications are that some of the more prohibitive proposals that were released earlier this fall are simply not going to happen in 2022.
And Matt, can I ask, the SALT tax comes up so often because the majority of our clients are in the Northeast. Could you maybe talk a little bit about what has transpired more recently specific to that?
So, as many of you know, you are limited to a total of $10,000. And by the way, it doesn't matter if you're single or married, the $10,000 applies to just about everyone on state income tax deductions and local income tax deductions, which is essentially your property taxes. And as a result, unless you have a lot of mortgage interest or charitable donations that you make throughout the course of the year, you take the itemized deduction rather than you take the standard deduction rather than the itemized deduction. So the point is that you're not getting the full bang for your buck had you been able to fully deduct your state income taxes and your local taxes because of this $10,000 cap. So this is something that Congress has been looking at the last couple of years, and there seems to be a proposal afoot that would dramatically increase that $10,000 much higher. The latest number that I saw was $72,000, which would obviously be greater than the standard deduction, which is approximately $12,000 if you're single, $24,000 if you're married filing jointly. And that would in fact enable many of you to take much higher deductions on your tax return. So at this point, it's simply a proposal, but the prospects are promising, and we'll just have to wait and see what happens in the weeks to come.
That's great. Thank you.
You bet. So let's go into a discussion of, regardless of the chaos in Washington, D.C., what are some of the different things that we think individual investors ought to be thinking about in 2022, and a lot of the planning in order to get this in place needs to happen in 2021. So there's still time, but yet time is running out as we approach the end of the year. So we have a laundry list of ideas. Some are going to apply to some people. Others are going to apply to other people. I doubt every single one is going to apply to every single person, but I'm willing to guarantee that at least one may apply to at least one person. So everyone, we hope that there's something in here for everyone to go back and think a little bit more about. So let's go through these. The first is something called a health savings account. These are triple tax advantaged. And in order to be eligible, you have to be a participant in a high deductible healthcare plan. What does that mean? It means that the deductible has to be $1,400 if you're single, $2,800 if we're talking about coverage for a family. If you're in one of those plans, you have the opportunity to fund a health savings account, and the contribution is $3,600 if you're single, $7,200 if it's a family coverage. And by the way, if you're 55 or older, you get an additional $1,000 that you're able to put into your HSA. The beauty of the HSA is that the money is deductible, and it doesn't matter what your income is. It's 100% deductible for everyone. The money grows tax deferred, and as long as you use it for qualifying expenses, it comes out tax free. There's nothing else out there quite like a health savings account. Now, some of you may be familiar with something called a flexible savings account that you set up through work. It's sort of a use it or lose it proposition, which essentially means you put the money in on a pre-tax basis, but you have to use it shortly after the close of the year, or else you lose it. The beauty of the HSA is that there's no requirement that you have to use the money. So what a lot of people do is they go into the high deductible healthcare plan, they fund an HSA, and if they have to go to the doctor or if they have to fill a prescription, they just pay those expenses out of pocket, and they allow their HSA to continue compounding tax deferred with the intent of using it as a sidecar in retirement and using the money in retirement for unforeseen healthcare expenses. Of course, if you need the money sooner, you can always take it out. And if you take it out for non-qualifying expenses, there are taxes and penalties. So you want to be sure you use it for what it's intended to be used for. But the beauty of the HSA is that there's nothing that says that you just can't simply let your money continue to compound and use it as sort of a supplemental savings vehicle, particularly for retirement, when at some point things pop up, unexpected medical expenses, and having a funded HSA very well may be an ideal way to meet those expenses in retirement.
Matt, that's great. Thank you. And you started with the triple tax-free comment.
Mm-hmm.
There really is nothing else out there that you can say is triple tax-free, except for maybe a couple of things, correct?
Yeah, there's nothing else out there. So on the traditional IRA, you get the deduction up front, but then you pay taxes on the distributions. If you do a Roth,
right,
the money goes in after tax, but it comes out tax-free. So it's usually one or the other. The beauty of the HSA is it truly is triple tax advantaged.
Truly unique. So thank you.
So the next strategy we have, which is not necessarily a new strategy, I think many of you are probably familiar with 529 plans. And if in fact you have children or grandchildren and putting some money aside for their college education is a priority, there's really no better game in town than the 529 plans. And the reason why I say that is for prior generations, we used to have what's called custodial accounts. Depending upon your state, that may be a UGMA, Uniform Gift to Minors account, or a UTMA. Those were subject to taxes on an annual basis on the earnings. However, the bigger problem is that once the child reached the age of majority, he or she could call up whatever institution that account was held and essentially take their money because it was theirs. The beauty of the 529 is that the money grows tax deferred, and provided you use it for qualifying expenses, it comes out tax free. Not only that, but you as the account owner or whomever sets this up on behalf of a child can always change the beneficiary. So child number one grows up, they decide that college for whatever reason isn't for them, they take a different path in life. Or maybe they get a full scholarship. So now all of a sudden you don't need the 529. What do you do with the money? Well, you can change the beneficiary to someone else in the family. So that would include siblings, cousins, etc., and do essentially a rollover into their 529, and perhaps they can use it. So these are really, really neat accounts and very, very popular. Every state offers a 529, and in many cases, you don't necessarily have to be a resident of the state in order to take advantage. However, if your state plan offers a state income tax deduction to fund your own state plan, then I would say you probably want to start there. But like anything else in life, some are better than others. And so while it's usually best practice to start with your own state plan, whether it's Connecticut or New York or New Jersey, wherever you reside, keep in mind that you have the flexibility if, for whatever reason, that plan doesn't meet your needs to take advantage of any of the other plans out there, because usually there's no residency requirement whatsoever.
Matt, thank you for going through that, because I think that the state deduction is always a little confusing to people because every state is unique. And for most of our clients that are in Connecticut, right, this would be a great point to maybe highlight that Connecticut does allow a state deduction, and that recently transitioned to Fidelity, who happens to be our custodian. So
okay,
yeah.
So if you are a resident of Connecticut and you're interested in this for either a child or a grandchild, given the fact that one, you get a state income tax deduction. Now, it may not necessarily be a deduction on every dollar put into the plan. Depending on the state, they're usually capped at maybe $1,000 or a couple of $1,000s, even though you might contribute more. Keep that in mind. But the fact is, you still get a deduction, which is something we can all use. And Fidelity, of course, is a leader in a lot of different businesses, including 529 plans. It's a great idea to just simply start there.
Yeah, thank you.
So let's move on to our third strategy. And so this deals with gifting. And for those of you who have adult children, or adult grandchildren. So I'm not talking about minors or people who are in college who you claim as dependents. I'm talking about, let's say, people who are in their 20s, maybe 30s. They're just starting their professional lives. Maybe they're living in Manhattan and they're struggling with rent. And so maybe you want to help them out a little bit and provide some financial assistance. What most people do is they might just simply deposit cash into that person's banking account. And certainly there's nothing wrong with that. But here's an alternative strategy to think about. Usually the recipients of that financial generosity are in lower brackets. And for many of you who are on the call today, your capital gains rate is either 15, for some of you, it's likely to be 20%. So if you were to sell something that has an inherent gain, that's the capital gain rate that you would pay on the appreciation. However, what's really interesting is that for people who are in the lower brackets, so what do I mean by the lower brackets? If they're in the 15% rate or the 12% rate, or even the lowest rate, they don't pay any taxes, their capital gain rate is 0. So again, we're talking about 20 somethings that are out there just starting their professional life. They're in the 10 or the 15% brackets. What you can do is you can gift them appreciated stock. And if they turn around and sell that stock by virtue of the fact that they're in the 15% rate or lower, there's no capital gain. So even though they inherit your cost basis, so if you bought Amazon many, many moons ago at, I don't know, $50 a share, and now it's $1,000 a share, so it's all this pent up appreciation. If the recipient of that gift sells the Amazon stock and they're in the 15% bracket, there's no capital gain. So this very well may be an alternative to, well, I want to provide some financial assistance to family members and I'm going to provide a cash gift. And certainly you can do that, but there may be an alternative strategy with appreciated stock. Now, a couple of things to keep in mind. One, again, this isn't going to work with minors because they're subject to the kiddie tax and people who can be claimed as dependent. So we're really talking about young adults. And two, and I'm just going to use an outrageous example just to make the point. If you gift someone $1 million worth of stock and it's all appreciation and they sell it, well, they're no longer in the 15% tax bracket. They're now in the highest tax bracket because all that appreciation is going to push them into the highest tax bracket. So depending upon the extent of your generosity, there are limits. And if this is something that you're interested in, you want to work very, very closely with your CPA to make sure that the appreciation that they're going to realize doesn't push them in the higher tax bracket above the 15% rate, because now they're not going to be able to sell it with 0 capital gains tax.
That's fantastic. Thank you. And I think that's a very important point at the end with, including the accountants in the conversation.
Absolutely. Absolutely. Yep. So let's move on to another strategy, which is very popular this time of year, and it's harvesting capital losses. And this can be done anytime during the year, but people usually begin to pay more attention as we get into November and December as part of year-end tax planning. Now, the markets have been great. So a lot of you have stocks and mutual funds that have done nothing but appreciate, which is great. But if you have some stocks or mutual funds that maybe haven't done as well and they're at a loss, so you bought it for 10, it's now 8 or whatever, what you're able to do is you're able to sell and you're able to capture a capital loss. And the beauty of doing that is your capital losses offset your capital gains. And by the way, if you have more capital losses than capital gains, you're able to use $3,000 of those losses to offset ordinary income. And if you have leftover capital losses, then you're able to just carry them forward into future years. So let me give you an example. You bought a stock at 100, it's now 90, you sell it. Now you're able to claim a capital loss to offset any other capital gains that you have. Now, a lot of people say, well, wait a second. Yes, it's at a loss, but I still feel really good about this investment. Well, the rule is that you have to wait 30 days before you buy it back. If you buy it back within the 30 days, that's what's known as a wash sale, and you're not going to get credit for the capital loss. So that's the downside. People always ask, well, what's the downside? The downside is that stock that's 90, you bought it at 100, you sell it today for a loss, you intend to buy it back 30 days from now, and it's 150. Okay, well, I should have probably just held it instead of playing around and trying to capture a capital loss. That's the downside. There is something out there called doubling up. And essentially what that means, it's a little complicated, but what it means is you have your stock that you bought at 100 and now it's at 90 and you want to sell it, but you're afraid that maybe something will happen in the next 30 days where it will appreciate significantly. What you could do is you can double up. You can buy more of the stock. So now you bought some at 100, you bought some at 90, you wait the 30 days. If you're right and the stock appreciates, well, you made money. But if you're wrong and the stock didn't appreciate and it's just kind of lingering around at 90, what you do is you sell your original lot that you bought at 100. And so now your new cost basis on your newer lot is 90. So again, you want to work with your CPA, absolutely. But you probably want to start by taking a look at your portfolio and seeing if there's any candidates out there. And if there are, then let's rope in the CPA and let's talk about taking advantage of this before the end of the year.
Great, Matt. And just to highlight what you've already mentioned, this is outside of a retirement account, right? This is not an IRA.
Yeah, so IRAs are tax deferred, 401ks are tax deferred. I know some people, well, I'm going to take the loss and then immediately buy it back in my IRA. The IRS doesn't like that. So we're talking exclusively about non-retirement assets. Absolutely.
Great, thank you.
So here's another strategy that we think about from quite often, and it's not really year-end planning, but it has to do with something called asset location. And I know everyone knows what asset allocation means. That in simple terms is, well, how much stock should I have and how much bonds should I have? So asset allocation recognizes the fact that many of you have IRAs and 401ks, and you also have savings or brokerage where you just own stocks and bonds in your name or in joint with rights of survivorship with your spouse or partner. And it recognizes that the tax treatment of those different buckets or different pools is very, very different. So let me give you an example. If you buy a stock and you hold it a year and a day, you get the more favorable capital gain rate. And that is not higher than 20%, even if you're in the 37% bracket. However, if you make the same exact investment inside of an IRA or a 401k, there's no capital gain treatment. Mm-hmm. So the distribution, you can buy and sell and everything's tax deferred, but eventually the money comes out. And when the money comes out, it's going to be subject to your ordinary rate, even if it's 37%. So the thought process is, because you have different pots of money, and some of you may even have three. You have the tax deferred, you have the taxable, which is the savings and brokerage, and some of you might even have a Roth, which is tax-free. So now you have three buckets of money. And so the thought process here is to think about, well, what investments should go where? And so things like bonds, which pays interest. Interest is always taxed as ordinary income. Strategies where there's a lot of buying and a lot of what's called turnover, where there's buying and selling, buying and selling, buying and selling. Look, if you're making money, you don't mind, but all that buying and selling is going to trigger taxes if you're successful. If you can kind of think about using your tax deferred and your Roth money for those sort of investments, and if you're going to buy a stock and you're going to hold it for the next 100 years because you think it's a great investment and something you want to pass down to future generations, then probably what you want to do is try to use your savings and your brokerage for those sorts of investments. And by the way, if you leave your savings and brokerage investments to your children or grandchildren and there's appreciation, they get what's called a step up in basis. which essentially means when they inherit those stocks, bonds, and mutual funds, the asset is revalued. And whatever the value is when the inheritance occurs is now their cost basis. And all the appreciation that occurred during your lifetime is essentially forgotten about. That's another change that they wanted to make for 2022, but that's thankfully been taken off the table. So that's what we mean by asset allocation. And it's just, it's not meant to disrupt what you're already doing with your investments, but it's meant to maybe do a little fine tuning around the edges to make those investments a little bit more tax efficient.
Matt, I love that you brought this up because I personally think that asset location is not utilized in the industry enough. Because, and you talked about this isn't just buying municipal bonds versus taxable bonds, but it's also different types of equity strategies, dividend paying stocks versus growth stocks. And so this is something that we do pay attention to at Principal Wealth Partners. And so hopefully some of the clients that are listening have heard these conversations from us in the past.
Thank you for sharing that. That you're absolutely right. It's a true differentiator. So yes, asset allocation, there's many different places you can go where someone can help you figure out how much stock, how much bond, how much US, how much non-US, but a true differentiated service is to layer the asset location to the extent possible. Sometimes people only have retirement money, or sometimes people only have non-retirement money. So for a variety of reasons, they may not have different buckets. Okay. But for people who do, and many do have different buckets, this is definitely an opportunity because you're going to live off of what's left after taxes.
Exactly.
So yes, returns are important, but returns after the taxes are paid is actually what people are going to live off in retirement. And so that's really the number to focus on.
Absolutely. Thank you.
Okay, speaking of muni bonds, we get this question all the time. Why do I want to buy a bond? I'm going to get 2 or 3%. I'm going to tie my money up for 7, 8, 9 years. It just doesn't seem like a very good trade-off. And that's perfectly understandable. But let me explain why bonds could still have a place in a portfolio. Bonds have a place in portfolio because we don't know when the next black swan event is going to occur. So what do I mean by a black swan event? Well, COVID-19. Who saw that coming? Now, the good news with what happened in 2020 is, yes, there was a major market correction, but it rebounded pretty quickly. If we go back to 2008, there are some who claim they saw it coming, but most people didn't see it coming. That rebound took a whole lot longer, if you remember. So there are these events that sometimes pop up over the course of our lifetimes. And we know that if you look at the charts and if you look at the data, if you buy stocks and you're a long-term investor, and if you're patient, you're going to do well. But however, we also know that from time to time, there are going to be bumps in the road. And the problem is we don't know when those bumps are going to occur. And when is the worst time to sell stocks? When they immediately fall in value, because you're not giving yourself an opportunity to recoup those losses. And so the beauty of having at least some bonds in a portfolio is that it buoys the value if we were to occur or hit one of those speed bumps. This is especially important for retirees because if in fact you're living off of your investment portfolio and we hit one of those speed bumps, you have no choice but to sell some of your stocks immediately after they decline in value. But if you have a portion of your portfolio allocated to bonds, then maybe you're buying yourself time where you're going to sell some of your bonds to meet your cash flow needs, and you're giving your stocks time to recover. Sometimes it takes a few months, sometimes it takes a few years. We just don't know. The Great Recession of 2008, that took a few years. COVID-19, that took a few months. We just don't know. But the beauty of bonds is that it buys time. There's also something out there called the asymmetrical nature of gains and losses. What do I mean by that? Well, if I start with $1 million, just to keep the numbers simple, and my portfolio declines by 20%, and I open up my statement, I'm going to see $800,000. Not a good day. And what a lot of people want to know, when am I going to get back to where I was? That's the question that everyone wants to know. When do I get back to where I was? So in this particular example, I want to go back to the million because I'm now at 800,000 because my portfolio dropped 20%. Well, guess what? To get back to the million, I now need not a 20% return, but a 25% return. And if I'm pulling money out because I'm retired and I need to spend some of it to meet my lifestyle needs, then I'm going to need even a greater percentage in order to get back to where I was. So I understand the concern about the low interest rates and how it's not very appealing in this environment, but there's still a place for some bonds in portfolios. And they're all different types of bonds. I'm talking about muni bonds because they're tax-free, which of course are attractive particularly in places like California and the Northeast. But that said, there are a lot of different types of bonds depending upon your unique set of circumstances. So keep in mind, it's not just about the interest rate, why these are important to think about as part of a diversified portfolio.
No, that's great. And I think the asymmetrical loss is such an important one as an example of why it's still a viable asset class. Can I ask you, because, coming out of this pandemic, there has been concern about owning bonds that are backed by municipalities, but it sounds like Janus still believes that this is a viable asset class to own.
Well, let me say this. Janus does not have a municipal bond strategy. So we have no dog in the fight.
Okay. Yeah.
So here's the thing about muni bonds too. If there's concern about the credit worthiness of a particular state or municipality, you could shop elsewhere. Now, it's not going to be tax-free for Connecticut state income tax purposes if you buy an out-of-state muni bond, but it's still going to be federal tax-free. So I know we talked about 529 and shopping in Connecticut, and I'm not an expert on the credit standing of different states, Connecticut or otherwise. But if there's some concern, then what you can do is you can shop and look at bonds that are issued from other states that may have a better credit standing, a little bit safer from that respect. Again, you give up the state income tax issue. However, it's still federal income tax free.
Yeah, no, that's great. Thank you for bringing that up, because for a lot of our clients where we do utilize municipal bonds, we do tend to buy them on a national level for, and part of it is the credit worthiness. So
the credit worthiness and many investors who live in Illinois,
right.
The exact same thing for the exact same reasons.
Or if you live in Puerto Rico.
Or if you live in Puerto Rico. Okay, so the last strategy we have for you today is something called a donor advised fund. And so this is a charitable strategy. And the way that it works is you open up one of these accounts and you're able to contribute cash, you're able to contribute stocks or bonds that maybe have appreciated. You get the deduction now. Now remember, in order to itemize your deductions, in aggregate, they have to exceed the standard deduction. So it depends upon other things, but I'm going to talk more about that in just a sec. Let me talk about how these work. You put the money in. Now, it's irrevocable. So once it's in, it's in. Okay, so keep that in mind. You get the deduction now. However, you do not have to choose what charity is going to receive a grant until you're ready. So a lot of people who need a last minute tax deduction, open up a donor advised fund, put the money in, get the deduction now in the current year, and then worry about, well, what charity? Is it something locally? Is it something nationally? Is it something globally? what charity is going to benefit from my generosity. So usually the way that these work, and they're all different, but you can usually put the money in. If you have appreciated stock, you put the stock in, you liquidate the stock because it's going to a charity. The appreciation is not recognized as a capital gain, just as if you were to gift the stock to a charity outright. You can invest the money. Usually there are a bunch of different investment options until you're ready to make the grant. And then when you decide upon a charity that you want to benefit, you let the donor advised fund know that this is where I would like my money to go and how much. These are really great for those of you who have adult children. It's a great way to teach them about philanthropy. And so what we have seen some families do is they set up a donor advised fund, they put the money in, they get the deduction, and then they go to their adult children, or if it could be a teenager. It has to be age appropriate, but it could very well be a teenager, and say, this is what we're doing as a family. Your job is to do some research and to figure out what charity you think should benefit from our family's generosity. And I cannot begin to tell you how empowering that is. What a great way to teach children or grandchildren about philanthropy. Now, there's always going to be the one or the two who's going to get mad when they figure out, well, they're not going to be the charity. They're not getting the money. Okay, so we need to kind of work through that. But these are real easy. They're real simple. You don't need a lawyer to draft anything. You don't need to file anything with the IRS. It's almost as easy as opening up a brokerage account or a savings account. There are always fees, but the fees are generally really, really reasonable. And so it's super, super easy. And just because you open it up and fund it doesn't necessarily mean you ever have to fund it again. It's entirely up to you how much of this you want to use and to what extent. Now, I said a little bit earlier that in order to get the itemized deduction, you have to be above the standard deduction. So here's an example of some ways that people use this. You have a $10,000 cap on state and local taxes. Your standard deduction is $12,500, $25,000 if you're married. So above and beyond state and local taxes, you need enough deductions to get above that threshold to get the full tax benefit. And so what some people do is they do an every other year strategy. So let me give you an example. Let's say I want to do $10,000 a year. So if I get the $10,000 on the state and local taxes and I put another $10,000 in the donor advised fund, that gets me to 20. Well, I would just take the $25,000 married standard deduction. So I really don't get the benefit of the tax deduction. But what about this? Instead of $10,000 every year, I do $20,000 every other year. So now I have my $20,000 to my donor advised fund. I have my $10,000 for my state and local taxes. I'm at $30,000. The threshold is $25,100. Now I'm going to itemize. So I get the full benefit of contributing to a donor advised fund. I just simply lump my contributions every other year. So these are really, really neat. And I know for a fact Fidelity has one, which I know is very, very good. So if you're interested in learning more, please ask, because these are real simple to set up.
Yeah, I have to tell you, we are a big fan of the donor advised funds here. And so I think many of our clients listening are familiar with this strategy because they are utilizing it. And you also, such an important point. I think a lot of parents are struggling to have these conversations with their children around their financial situation and money in general. And this has been a great avenue to start embracing that conversation. And that's some of the feedback that we've heard. So thank you for that. And I have to say this, Fidelity actually just sent us a report this week on our firm overall and what our clients granted this year. And I have to say, it's so impressive to see how generous our client base is. So,
well, that's terrific. And so, yes, there's a tax advantage to doing this, but for a lot of people, it really transcends the tax benefits.
Absolutely. So, thank you for highlighting all this,
which is their motivation. So those were the strategies. That was the update in Washington, and those were the strategies. And let me turn it back over to you to see if there's any other questions or comments or anything else you would like us to hit on today before we wrap it.
No, I know I peppered you with questions throughout the entire presentation, so I appreciate that. I think really in summary, you highlighted a lot of strategies. And again, it might not warrant, every single person to benefit from each and every one, but I think there's a lot of ways that individuals can think about improving and making more efficient their tax situation. So thank you for those highlights, because some of these can get a little confusing.
Mhm.
And I should say at this point that if anyone does have questions, any of us here at Principal Wealth Partners are happy to follow up, and we have some great resources such as Matt to go to if we need assistance with those answers. So thank you for all of that insight. Again, we appreciate what your comments are, the research that you all had from Janus as well, and we hope to have you back.
I would love to come back.
So well, thanks, Matt, and I hope you enjoy the holiday season with your family.
Same to you.
Great.
Okay. Have a nice holiday, everyone.